What's up? I'm Dan Fredenberg, and this is another chance encounter.
Hey, what's up? I'm Dan Fredenberg. I'm a commercial real estate guy. I'm from the internet. We're seeing more properties like this being built in front of a house that's going to be torn down soon. I understand that there are power lines that are getting kind of close. What's up again? This is Dan Fredenberg, and that there is a commercial real estate building.
I'm joined today with Michael Rebelo. How are you doing today, Michael?
Dan, I'm great. Great to be on here. Thank you so much for this opportunity. I appreciate it.
Oh, definitely my pleasure. And I got some great news for you, Michael. I didn't prep you for this before the show, but you should know that today we're actually joined by my very favorite member of the audience. And why is my favorite audience member here? It's because this is a chance encounter where I interview commercial real estate players. That means deal sponsors, passive investors, buyers, sellers, all that kind of stuff. And you might ask yourself, why would you do that? And the answer is, if you've ever heard of the off-market private deals that you're not supposed to discuss, then you should know that the SEC requires that for a 506B deal, you need documentation of your prior substantive relationship, or else they'll get ants in your pants and they might take away your business in the form of rescission. That's super duper bad. And so I have people on here and we talk about, okay, so what exactly are you doing in these deals? What exactly are you looking for? And all that sort of excitement. What's in it for you is that you will learn how to more effectively communicate on the subject of a commercial real estate deal, and you'll understand how my guest fits into those deals. But before we get too excited about real estate, Michael, do you want to introduce yourself a little bit?
Absolutely. So I'm a multifamily real estate investor. I started this business at 17. I'm currently 19 years old right now. I'm happy to announce that I'm co-GPing on 152 units right now at Tyler, Texas. So hopefully this is a very large milestone for many more to come. Out here based out of Tucson, Arizona. We really want to stick with the Tucson and Phoenix markets. Love this business, love working with people, love bringing people together, like-minded individuals. Yeah, that's what I do.
Excellent, excellent. I love it. And that brings us to the first segment of the show. It's the 5 distinct motivations. Before I do that, though, especially with youngsters such as yourself, you know, young people are supposed to understand tech. And so we got to say, but wait, check your 8. Michael, I don't know if you can do this for me, but can you try and look through the camera into the user's device, and down there might be this big, hideous subscribe button, and maybe they should do something about, it's a stupid joke, but whatever. Anyway, the 5 distinct motivations. I've now literally interviewed hundreds, I'm pushing like 400 different commercial investors on this Chance Encounter series, and everybody has their own unique reason why they're getting involved, why they stay involved. And even though that's the case, I find they fit pretty neatly into these 5 distinct motivations. And the reason why it's relevant to know what that motivation is, or what combination of them really motivates the guest, is because sometimes deals don't go your way. And if you know the motivation, then you know what's keeping this person from throwing in the towel when the going gets tough. The first distinct motivation is preservation of purchasing power. What on earth is that? Well, if you're in a situation where you're able to invest like once a year or maybe multiple times per year, you're basically earning more than you are spending, you're not just living hand to mouth, then you need to protect the purchasing power of your extra capital. And otherwise, if you're in this situation, you might be a retiree, where basically the real distinguishing factor of this one is that you are not really going to pull the trigger. You're not going to make the jump, make another acquisition, make another investment, unless you're getting at a steep discount, or if like for example, inflation is eating away from the purchasing power of the cash flow of your portfolio of assets. That's when you're going to pull the trigger, whereas some people have to make deals just for deal's sake. And just full disclosure, this is not where I am in my own real estate journey. What describes me better is a little bit subtle. It's trading time directly for wealth. And to fence that in a little bit, my background is in tech. Specifically, I have a CRM agency to help people with their mass marketing online, and I've done that with all sorts of different, 7-figure and up revenue generating companies. But since 2014, I've been focusing in the real estate sector, doing the tech stack help and also some marketing podcasting like the one you're watching right now to try and support different real estate businesses. But as I watched my old boss flipping 10 houses a month, he was basically doing 10 transactions a month on single family, it hit me that, hey, wait a second. As I build my salary, I'm paying more and more in tax. They're basically taking half after everything's said and done. So maybe I'm on the wrong side of the right business. And I decided to pivot to try and fetch the deployed capital, aka equity. So that's what's in it for me as far as getting into the real estate industry. And I get that that's fairly subtle. Some people don't know what I'm talking about when I'm talking about that. And that's probably because they're more motivated to fast track their retirement or at least take control of their schedule. They want to be able to live on their own terms. Maybe they want to hustle like crazy in their youth so that they can retire early, or maybe it's just so that they can be at their children's baseball games or whatever like that and not have to ask anybody for permission. And I definitely get that. The only flaw that sometimes comes out when this is the main motivation is they think that that's everybody's main motivation, and I assure you that is simply not the case. Some people are fueled purely by ambition. They want to buy their entire hometown. They want to get that generational wealth to make sure that their great-grandchildren never have to hold a day job, and that's why they're going to hustle into their 90s. And I get that some people vilify that sort of attitude, but the fact is, it doesn't matter if you're talking residential like multifamily or if you're talking about retail commercial property. The fact is, somebody has to stay motivated to you basically not fall asleep at the wheel. Make sure that the place is being adequately maintained, and that makes real estate a much better industry as a whole. It's the people that are asleep at the wheel that are give the rest of us a bad name, I'd have to say. But of course, some people, they're going to hustle into their 90s, but it's not so much out of ambition. It's because they've picked a sector of society, or maybe it's animals, maybe it's the environment. Who knows what it is, but they picked something, they want to make a big impact, and they found out, hey, there's a financial component to that. So they're figuring out, what else can I do with my capital to make it grow and grow and grow so they can give to that cause. Now, Michael, as far as you're concerned, those 5 different motivations, what combination of them would you say describes you best?
Well, if I have to pick at least 2, I would have to say this one, for example, the one you have up right now, helping people who need it. I got into this business, 1, of course, 1, to make money, but 2, to actually put that money to a better cause. When Mom and I were sitting down, trying to figure out what would be my main motivation, she was trying to help me, coach me through this. Sure, you're here to make money and here to build a business, a real estate empire, but what is the outcome for other people? Like, how are you going to impact other people? So I was sitting there, I was contemplating this, and all of a sudden it just hit me. I'm like, why can't I give back to our veterans? I mean, there's so many that are homeless, that are struggling right now. I'm like, they fought for us to have this ability where you and I can talk on this podcast, where I can sit at home feeling comfortable and realize that a lot of them have given their lives. In fact, Memorial Day and D-Day just passed. So it's like, I want to give back to those that's given me the opportunity to actually succeed, to live in the United States of America, and to help others because they served us. And my mom, she was like, I agree with that because we need to give back to them. I mean, I'm still shocked and heartbroken that there's still so many homeless that are like, they served our country. Why aren't we taking care of them? They should be our main priority. But that's really where I stand with, help people who need it. I feel like those are the people that truly need it. My next part would be the fast track to retirement. There's a lot of people that I've known before and that my friends' parents are still working. Like, retirement is even in question, where they're working till their 60s, 70s, just to make ends meet. So I was thinking, obviously nothing's getting cheaper. Life exactly isn't getting easier, especially with economic changes, different changes across international waters, whatever it may be. And I was thinking, why aren't people having their money make money for them. They're making the money, but what is that money doing? Now I want them to keep their money, but to also have their money put to work. And that's my goal, especially with my mom. Like, she still has a W-2, but I don't want her to be in that W-2 forever. I want her to enjoy life, to enjoy the riches of the planet, you know, what the good Lord has given us, to enjoy time with her family, to enjoy time with my future family. So it's like almost like, you know, the better cause of helping others, but also to give time back and to give people an opportunity to enjoy their life quicker instead of just waiting for the retirement account for the 401k to just pan out. And a lot of people have said, you know, my 401k has been suffering due to market changes, whatever. So it's like, you know, you can't control your 401k unless if you had a previous one. But what if you could do something with the capital right now to actually make sure that your retirement's secure and that you can probably get it quicker? So I think those are the two main things that stick out for me, that really hit home for me, especially when going to this business, kind of like my whys, to be honest.
I love it. I love it. Now, of course, whenever we're talking about motivations, we run the risk of seeming, too optimistic, things like that. And the fact is, real estate's a business, and just like all businesses, there are risks involved. And this next question here, it stems from, if you've ever been involved in one of these off-market deals, the private deals you're not allowed to publicly discuss, then whoever the SEC attorney, the securities attorney that's in the mix, they should have insisted that everybody who's involved fills out this super invasive financial questionnaire. What's your net worth? What's your income look like? What kind of investment experience do you have? And it's pretty uncomfortable. But when I was filling out one of those forms, there was one question in particular that I felt it lacked utility. And the reason it lacked utility is I found that of the 4 or so multiple choice answers, none of them were really, it just lacked utility. I couldn't really take it to the bank, so to speak, as far as knowing what somebody's tolerance for risk was. So the tolerance for risk question that I ask is a fill in the blanks question. It is, there are many popular investment asset classes, but I think blank is too risky. So Michael, it can be inside real estate, it can be outside real estate. You can give one of each if you want. What's too risky for you to invest in?
I would say single family homes. And the reason why I say that, of course, there's a lot of people that had success with single family, but here is the backside of it, where multifamily, you could have 5, 10, 15, 20 units. And if someone leaves or if you have to evict them, you still have a lot of other tenants still paying the rent and you're still getting the cash flow for that. Now, if you have one tenant in a single family home and they leave, your cash flow income is pretty much zero. And then you have to wait, and then you got to spend more money on marketing to make sure you get that rented. So I think it's just too much of a day trading mentality, that if there were something to happen with the renting, I guess you say renting space, and someone just to jump ship, and then you're like, great, my income is gone. Now, if you have this like a tiny side hustle, just for some extra passive income, and if they leave, you can still survive on income, sure. But if you want to use that as a main business, I personally think you should go bigger, because if you have like a duplex, if one of them leaves, you still have another. Sure, is your cash flow cut in half? Yes, but you still have income coming in. So I really think that single family space is, for me personally, for my risk tolerance, too risky, just because of that risk of cash flow going. And Dan, you know as well as I do, with the housing market right now, a lot of people are moving to apartments or just shifting to renting. Could it change for the single family space? Absolutely. But as of right now, just from looking at the 10-year trend, I really think that that would probably be the most risky move, at least for me.
I love that answer. And it really comes down to cost per door as far as my math goes. It's like, how much are you risking per income stream? And when you're investing in an apartment building, you've got a much lower cost per door than a single family house. I love that answer. And it brings me to the next segment, which is about the favorite deal metrics. And full disclosure, I thought that this question was a little bit too fastball at first. So for the first 1 or 200 chance encounters, I didn't ask this one because I knew there'd be some people. This is a very what do you want to call it, a hustle intensive industry. So the thing is, you need all all types of people helping in your real estate company. And sometimes that means they are front of house, they're marketing, they're public relations, that sort of stuff. Maybe they're not the spreadsheet junkies who are really underwriting the deals, finding out all the secrets of the financials, finding out the facts. And but I found that even if you are front of house, you are somewhat of a curator of deals. So you have to decide, okay, which one is the one that I'm actually going to add to my portfolio. I'm going to try and bring my organization to it to make as an acquisition. And so that's why I started including it. And for anybody in the audience who is only listening and they're not watching, I read out all of these. It's not an exhaustive list, but I've got 14 so that people can say what they really focus on. The first one is cash on cash. Then I have IRR, which is internal rate of return, also known as an equity multiple. In other words, what's going to happen to your capital throughout the investment. Then there's the cost per door, which I was just mentioning as a form of risk mitigation. There's the net operating income itself. There's the going in cap rate. That's because different companies publish the standard or typical cap rate in any given area. So that's a back of the envelope way to find out what kind of discount you're getting on the acquisition right off the bat. Then there's the loan interest rate, which is especially important if you're going to be assuming a loan these days, because we had such a low interest rate environment recently that and that kind of disappeared over 2023, somewhere around that neck of the woods. But then I've got the occupancy rate, which is the inverse of the vacancy rate. So it's the same thing, it's just inverted, but also very important. We have the average income where the property is located, the amortization period of the loan, also very important if you're going to be assuming a loan. There's the difference between the market versus the in-place rent. There's the population growth where the property is located to give some baked-in demand for that extra inventory. Then you have the sponsor record, which is how many deals are on the go right now, how many deals have already gone full cycle. Then there's the waterfall split or exit strategy, which is basically talking about what happens to your investment after your principal has been returned. Are you basically stuck finding another deal? Are you in until sale, that sort of thing. And lastly, I've got DSCR, which is debt service coverage ratio, which basically talks about how much of the revenue is going out the door immediately just to pay for the loan. Now, again, this is not an exhaustive list, so Michael, if there's some other numbers that you tend to focus in on, feel free to use those. But I don't know if you want to give a top three or whatever. What do you depend on most?
That's a really good question, Dan, and I love this question. So I first want to talk about DSCR. So obviously, you know as well as I do, and the audience I would assume too, we can't just go out to a bank and say, hey, I want to buy a $20 million apartment complex. I don't have $20 million. You don't have $20 million. But if we can get a loan of 60 to 70% of that, that's great. Of course, when we get a loan, we have to pay it. Now, that's when, how much is the loan interest coming in? You don't want to be butchered with a loan interest. We've heard of interest rates for the past 6 months. It's kind of been the elephant in the room. But besides that, we want to make sure that we're profiting while paying that mortgage off. So hitting a 1.2 DSCR, maybe more. If we hit more, that's great. But really, we just want to be sitting at a 1.2 or more, because we also want to be paying the mortgage, but we also want to be getting profit from there. So how much is actually coming out of the property in cash after paying the mortgage? I think that's very important. And I also know that lenders like to see that, what is that DSCR? Is the bank getting paid? Yes or no? Because they're the first people to get paid, or the first big investor to get paid. And then the rest of us, we get paid right after. So I think that's a huge metric to see, is this property actually performing as the bank has for standards? And if it doesn't perform, the bank could potentially foreclose it, or they could take it, or all of a sudden we might have to be forced to sell. So I think that's a very important metric, at least I like to look at. I also like to look at the population growth, because I don't want to be investing in a market where the population growth is almost flat for the past 5 to 6 years. And when we purchase a property 93% occupancy, it might go down, but I want to have people to fill in that. I want to make sure that where this property is sitting, there's growth around it, so the property can also grow as well. So if the population growth isn't exactly healthy, then what is the health of the property in the future? That's my worry. Is the market going to perform? If it's not going to perform, then the property won't either. And the last thing I also want to throw in there as well is the sponsor record. So I personally think a sponsor is super crucial. Sure, they might take a good chunk, especially if you're just starting out, but these are very experienced individuals with 15, 20, 30 years of experience in the real estate industry. And they could potentially be a mentor for you to learn, then you could become your own sponsor. Sure, are they going to take a huge cut? Absolutely. But these are the people that have done it and made the mistakes, have gone through the trials and tribulations, gone through market crashes, gone through the pandemic full cycle. And then you can see, like, okay, what is their average rent growth? What is their percent of exit? How do they structure their returns? What's the track record? Shop around, compare different sponsors. And then once you feel comfortable with the sponsor and you can work with them and learn from them, you could scale very quickly. Dan, you know as well as I do, it's one thing to hop on a webinar or to read articles, but it's one thing to actually do it. The best way to learn real estate is actually doing it. So if you have someone that's done the mistakes, that can teach you, that but can also help you with the property as well, I would take it. So I think those are my three, or at least big three metrics that I look for, whether it's a market, future trends, or a property. I think those are my big three.
I love that answer, especially the part about the $3 million. I like to tell people I left my $3 million in my other pair of pants, but I was just eating up that wonderful explanation like a delicious subscribe sandwich. It's a very subtle, you like that, huh, Michael?
I did for sure.
Excellent. But it's my reminder, it's time to bring out the Dan Does Deals Commercial Core Competency Cube with the 6 different main roles in a commercial real estate deal. I go through all 6 sides, and it really is the linchpin in helping you communicate more effectively on the subject of commercial real estate deals and understanding how my guest fits into those deals. Because when you get into this industry, everybody's an investor. You don't know what they're actually going to do. And that's what this basically parses out a little bit. And if you're watching me explain these different sides and going like, hey, I need to get me one of those cubes, the good news is it's absolutely free. You go to dandoesdeals.com and there's this big conspicuous button where you can just download the PDF. Yes, that's right. You heard me correctly. I committed the cardinal sin of marketing, which is you should always ask for some sort of contact information in return for your freebie. But I just like you that much, and so I'm like, okay, I'll let you print it out and share it with your friends and family and all that kind of fun stuff. But let's get started. The first role is the repositioner. They're the most public-facing people because they're looking at all sorts of different properties. They're doing all sorts of paperwork. They're underwriting the deal. They're doing the arithmetic. And the reason why that's so important, one is because they're looking for upside, but they need to establish, first of all, is this property even actually making the amount of money that the seller/broker claims it is? Because right? So the repositioner, right? Exactly. So the repositioner has their work cut out for them, and they're looking for that upside, trying to find more profitability for the property. But one of the most peculiar parts of repositioners in general is they have to have a wide network of financiers. So that's lenders, investors, bankers, all that kind of stuff. People who deal only with the paperwork, the owners, and capital. They are not operators. They're not unclogging toilets or anything like that. But the reason why repositioners have to have a vast network of financiers is because if you can secure cheaper money, like a cheaper loan, better investors, something like that, that automatically goes to the profitability of the building. So that's why you need to know a whole whack of them if you're in real estate in general, and everybody has some sort of repositioner roles, but that's how it goes. But the next place a repositioner is going to look after closing especially is they're going to look at operations and stop those Benjamins from going down the toilets. But of course, there's a lot more to operations than just unclogging toilets and mowing lawns and collecting rents. Me personally, my GP experience where I throw my hat into the ring, so to speak, is I help with the tech stack, but the bigger one is because I focus on bigger properties, we're talking 100 units or more, where you have a third-party property manager, you really have to know that vacancy is the real deal killer. So somebody on the GP team has to have some serious marketing chops to get those units filled, even if the property management company is struggling to do that. And so that's where I offer my services from my different skill set. So that's what operations are supposed to be doing. And of course, there's only so much upside a repositioner can find from optimizing those operations. So the next thing a repositioner will frequently do is they'll get a contractor team involved to renovate the place, make it nicer so that the future residents, the future leasees, I suppose, if we're talking other types of commercial real estate, they'll be happy to pay more in rent than the previous one if the place is nicer, in theory. Now, of course, you can do all sorts of upgrades with your contractors. You can gold plate the toilets if that's your thing, but I find it unlikely that you're going to get a return on investment. And then, of course, the other thing is the contractors, they might drag their heels, they might use subpar materials. So what are you going to do? Well, if you're like me, see, I don't know if you know this about me, but I'm from the internet. So that means I require locals, boots on the ground, somebody who can be there in an hour or two, because categorically that won't be me, because I'd still be stuck at an airport in an hour or two. So those boots on the ground are absolutely pivotal to make sure that the contractors are keeping to schedule, they're doing exactly what they're supposed to be doing, and also spot checking the operations, making sure that they're not sloughing photos, misreporting things on weekly meetings with the rest of the GP team, that sort of thing. So that's why those locals are so important. But for the sixth and final side of the cube, I prefer to do a little bit of a hypothetical. Let's say you are a physician or an engineer or an attorney, just basically a high net worth individual, a high earner, and maybe you already own a few rentals. So you go, hey, I know how this works. You get the down payment and then you borrow the rest. So full of confidence, you say to yourself, I want to buy that 350 unit apartment complex down the street. Hey, I bet you if I pool my colleagues and say, hey, let's each throw in 100K or something like that, we could take it over. So full of confidence, you turn around to the bank and you say, I want to buy that great big building over there. It's tens of millions of dollars. Do you happen to have, say, tens of millions of dollars you want to lend us? Well, they're going to hold you right in your tracks right there. And if you are in a mentoring or coaching program or something right now, I encourage you to listen very carefully, because the thing they're going to ask you is, who's the sponsor? Who's the KP, the key principal? And what that's all about is, if you think about where these lenders are coming from, these different banks or whatnot, they take depositor cash and then they lend it out. They are not in the business of losing capital, so they need to make sure that they don't lend it to anybody who's just going to run the place into the ground and basically lose all of the money. So they're going to require that somebody in the fold already owns a similar asset. In other words, if you're trying to buy a 350 unit apartment complex, you have to have a deal sponsor who already owns a 350 unit apartment complex. And on top of that, you need collateral. In other words, a balance sheet of at least the amount of the loan, and then you need a certain amount of liquidity to prove you can run the place. But if you got all those pieces, you got yourself a commercial real estate deal. So Michael, I know that you and your mom, you are repositioners in the sense that you're curators of deals, finding good ones to offer investors, and of course you're doing the investor relations and asset management. But I don't want to put words in your mouth. As far as those different roles, what are you guys mostly going to focus on?
That is a really good question, Dan. So I know for me, for example, or at least the both of us, we're definitely going to be working on the financing side, not either finding financing from either a bank or a lender, but to also bring people in to make it a syndication, or like you do, you work with funds. But from a syndication standpoint, we want to be the investor relations end, where we're curating people, we're educating them of what we do, and we're giving them another investment path instead of the 401k, CDs, IRAs, stock market, oil, gold, commodities, so on and so forth. And what we do is we try to pull as much of our investments we can together to get that down payment, to fulfill the rest of the purchase price, whatever's left over from lending, and then we just take care of the property. And the reason why I like to do that specific part is I get to teach people. And not only that, I'm a people person. I like to talk. I like to go to networking events. I've spoken on stage at Peak. I've spoken up in Scottsdale. I just really like to talk about what I do. And if I can help people profit from that and to teach people and to give them opportunity to either for their kids, their grandkids, or maybe right now for their retirement or just to get out of their job, I want to present that opportunity to them to say, like, hey, here's another option. Here's the next step if you want to go bigger. Like I always say, build better, build bigger. And that's what we want to do. However, I will say this, we also want to be a little bit on the reposition end where we want to find the deal, see if the deal can work. Because I can't actually pitch somebody or maybe bring someone into the deal without actually knowing it. So like, for example, I've had some people come up to me and they're like, hey, do you have $50K to invest? I'm like, I'm not liquid right now, but can you tell me about the deal? And sometimes they say, I don't know the deal, but my underwriter does. To me, that's a red flag, because if you're telling me about a deal that you don't know about, what else don't you know? Like, of course, we're not going to know the underwriting from like the back of our hand, but at least have a general idea of what the returns are, the purchase price, how long you're going to be holding it. So that's where the repositioner and I guess the financing side come hand in hand. I understand that the underwriter and acquisitions team may kill the deal to see, does this actually work? How many holes can we poke in, and is it still profitable? That means it can give me confidence to actually go out there and raise money for this. So I like the investor relations / financing part of it just because of that, because if I have confidence in those numbers, I can have confidence in myself to bring people to a good opportunity that I feel that their savings can be put into this and they can actually keep their money and have their money make money for them. I know that was a loaded answer, but that's where I stand.
Oh, absolutely! It's great to have that level of detail and make sure that you run through with a fine-tooth comb, because it's these investments are pretty big. It's a very capital-intensive business, so that's great. But the next question I'm sure that's on everybody's mind is the buy box, which is what do you focus on specifically? And when real estate people are saying, "Hey, what's your ideal property? What's your buy box?" Some question like that, we're really asking for three main things. First one's geography. Where is it? Which state? Which county? Possibly even which neighborhood. It will definitely matter. The second one's going to be size. I alluded to size a couple times already, and in multifamily or any kind of residential like that, we tend to go by unit count is the way of establishing size. The reason why it's relevant is because the type of company that will deal in 5 or 10 or 15 unit apartment complexes, they're going to be fundamentally different from ones that focus on 100, 150, 250, 350 unit apartment complexes. So that size matters. Now, of course, we're talking about commercial real estate here, and not all types of commercial real estate go off a unit count. Like warehousing, for example, goes off a square footage, but that size consideration still applies. Now, the third one, though, is usually called class. I don't like the term class because it makes it sound like it's only one thing when it's two. It is the condition of the property and the area. If you're talking about the condition, then it's talking about how old is the facility, how beat up is the facility, or how recently has it been renovated, and then what sort of amenities are included for people who have rented this property. So, like, for example, is there laundry facilities? Is there a swimming pool, hot tub, that kind of fun stuff? That's the condition. Whereas the area, yes, it does dovetail into the old broker trope of saying location, location, location. I don't like that saying, because I think what they really mean is traffic, traffic, traffic. If a gazillion people pass by a property every single day, it's going to have more baked in desirability, so therefore the demand's going to be there. But of course, the crime rate is always relevant in real estate. But if you are talking residential, like I generally talk about with my guests in multifamily, the school districts are also going to be vitally important as far as being able to ask for higher rents, finding that a little bit of upside. But both the area and the condition, they have the same rating system as they had on tests in grade school, where A+ is the highest, and then A, and then A-, then B+, and so on. So Michael, as far as you and your organization goes, where's the sweet spot? What's the buy box?
Great question, Dan. So I'm based out of Tucson, so I like to stay in my home market. So our main market is going to be Tucson, secondary market is going to be Phoenix, Arizona. So between those two markets, we like to hit 1980s and newer. The only reason for that is just we want to avoid the lead paint, galvanized piping, aluminum wiring, all that stuff we don't want to deal with that may be out of code. Next, for the unit count, we want to go with 50 units and higher with a maximum of 150 right now. Of course, down the line that may change, but as our current buy box is 50 to 150 units. As of property class, we want to hit a C plus, and the area we want to hit about a B minus to a B. The reason why I say this is because if it's a C plus in a B area, that gives us an area for value add. And those are the kind of properties we target. Either there's rent upside or you can renovate some of the units. That's the stuff we look for. Sure, are there core A plus that we don't have to worry about? Sure, but we really looking for that where we can boost cash flow, boost that appreciation, lower expenses, increase income, and basically to actually make a full-fledged business, improve properties, improve the market around it, improve people, and that's really what we look for. So buy box 1980 newer, Phoenix, Tucson, 50 to 150 units, C plus property, B to B minus market, somewhere where we can get a value add property.
I love it. And of course, there's the property, the investment itself, but of course, the other part is people. And honestly, the circle, this whole niche of real estate, people are absolutely the biggest attractor as far as I'm concerned to this industry. Of course, I came from tech where people are famously antisocial. So it's fun to get into real estate where people are so eager to make new introductions, build new teams. I basically chalk it up to the fact that real estate is multifaceted and nobody's going to be all 6 of these roles for any meaningful amount of time. You definitely pick your swim lane and you stick to it and you excel in it. And, maybe it's a couple, right? But at the same time, because everybody has their own unique skill set, we tend to be better equipped to help some people more than others. Of course, everybody in this industry, real estate is an industry of deploying capital. So everybody needs to meet more and more financiers, investors, and whatever. So anybody you meet in real estate, they are going to be interested in talking to you about potentially investing in their deals. But me personally, traditionally, I've always been looking for sponsors and KPs because they already have a real estate business established, and that's where I can make a bigger difference. When you're first starting in real estate, you need a bunch of grunts who can put in 80 hours a week. And sure, I could go ahead and do that, but that's not where I'm making my disproportionately large contribution, quite frankly. It's these different, this outreach, the content creation, the podcasts, these innovative shows that I keep on putting out there on YouTube and on LinkedIn and all these different social media channels. These sponsors and KPs are the people who I can tend to help the most. Now, Michael, I remember you mentioned financier, investor relations, all that kind of stuff. So of course you're eager to speak to them, but are there others like, operators in specific areas? Like who's out there in the audience that you're most eager to speak to?
So I definitely want to be on the same page, Dan, with you, especially with sponsors. I feel like they are very much a key role where they have that business in place, where we don't want to start ground up yet again, but we can learn from somebody else that's definitely a bigwig or they have a real estate empire that we can lean off of. One, for their education, but also number 2, to have a nice solid business partnership with them. And I feel like, just to have that security, that friendship / partnership with them, to learn and grow with them. They can teach us to do what they do, because we don't want to be just stuck basically as the grunts pretty much the rest of the time. We want to be able to scale. We're in the business to scale. This business is meant to scale, and sponsors can help us teach. They can help teach us how to scale, and eventually for us to become sponsors ourselves and to rinse and repeat the process. So I'm always looking for sponsors, always looking to connect with them, to learn from their expertise, build relationships with them, and do deals together. So I definitely look for sponsors as well.
Excellent. And so that must mean everybody in the audience is just begging to find out, how do we reach out? Now, of course, I'm going to sandbag that for a second, talk about myself. I'm fortunate to have this really distinct last name. It makes it really easy to find me, especially on LinkedIn, where I spend most of my social media time. Of course, I also have the hat that says dandoesdeals.com, where it's got interviews like these, and I am eager to speak to other people in the commercial real estate or investment space in that regards. Of course, if you take a moment and scan this QR code, that goes to my Amazon author page where I've got a few kind of mind-bending books there, like including Real Estate is a Scam, which is talking about the different things that you're unlikely to find out from a real estate coach. And so that's worth checking out. It's a great deal. It's not that expensive if you want to check that out. But Michael, as far as people wanting to reach out to you, is there a website or social media? Like how should people reach out?
That's a great question, Dan. So I got this QR code right here. You can scan that. They'll bring you to all my social media links, and also check out our company, EverForward Capital Partners. You can find us on Google business page, Instagram, Facebook, and LinkedIn as well. Also look for my profile picture and my name as well. But you can find pretty much everything with this QR code here. It'll bring you to my link tree, and you'll be able to see my podcast, my LinkedIn, all my social media accounts, and you can follow me from there, and we can connect.
All right, perfect. And that brings me to the final part, which is my public service announcement. And it's not so much for you, Michael, as for you in the audience, which is if you've been watching this episode and experiencing searing pains in your eyeballs, maybe like migraine-like symptoms, I'm confident it's due to the downright hideous subscribe button that's right there, and you can get rid of it for free. It's full disclosure, I urge people to hit the subscribe button so that those deadbeats at YouTube start paying for these videos instead of me. I think that would be absolutely amazing. The trade-off to you, just so we're clear, is my videos may show up on your list of suggestions, but you can feel free to just ignore those suggestions because, quite frankly, I just appreciate the fact that you spent this time with me. Just like Michael, I appreciate you joining me today. This has been awesome.
Dan, this has been a pleasure. Thank you so much for this opportunity, and looking forward to doing business together soon. Thank you again.
Sweet. Thanks. Hey there. Are you interested in commercial real estate deals? Would you like to build your network of investors and deal sponsors? Well, the best thing I can do for you is have you appear on a chance encounter interview as featured on dandoesdeals.com. You may know me from 506B.me or as a top commercial real estate voice on LinkedIn. And if I had to think of the top factors in your success in commercial real estate, my top two would be your network and your ability to effectively explain how deals work with effective communication. The 15-minute chance encounter format, it checks both of those boxes, and they ensure that you can share your private deals with me without the SEC calling it a public solicitation. So hop onto LinkedIn. You can see my name is over here, Dan Friedenberg, and search for my name. And the best way to reach me and book that is to message me through LinkedIn. And don't worry, it doesn't matter if you decided to enter this space just last week or 2 weeks ago, or if it was decades ago. It'll be fun and easy to look good. We're just asking multiple choice questions based on your core competencies you look to contribute, your level of sophistication, all that kind of stuff. So I hope to hear from you soon. Thanks a lot. Bye.